Hello, somebody should.
You can hear you, sir.
Okay, thank you. Yeah. So as I was saying, just as we have various taxes, like the personal income tax, the company income tax, the capital gain tax, value added tax, in which some of them. So we also have what is withholding tax. Is not another form of tax on its own. It's not. It's just what an advance payment of tax. As you see, it's your company income value added and is what and that is what that is us from pay from a third party. That is that it will be deducted whenever they, because government are of the opinion that
The network is breaking.
transaction that fall is breaking. Is it okay now?
It's a bit okay, sir.
Okay. Those particular transactions, that transaction, if they don't collect the taxes on them at the initial stage, no taxpayer will be willing to declare such income. So that's the reason why our government brought up this particular type of taxes, which is called withholding tax. For instance, like if you and I, those that are working, that are in paid employment, if you are in paid employment, so you now decided to invest that fund, as I was saying, in financial institution, in banks. So for investing that fund in banks, it's possible that bank will pay you what is called interest at so period of time. Do you think you and I, if they paid us that interest, you think somebody will be willing to declare to his employer? No, nobody will be willing to declare such income to their employer. So that's the reason why government came up with what? With this particular type of taxes, which is called withholding tax. So as I said, it's not a separate form of tax. So it's just an advance payment of taxes that is collected as so. When you want to collect, when you are doing a contract, so they collect it before making payment to them. So any amount that is now collected in advance, it is not a waste. It will be available for you as a set-off to reduce your tax liability. So that's just the basic about the withholding tax. So which we need to know. Recently, a new regulation came out on this withholding tax. A new withholding tax regulation which came out, which is the withholding tax regulation of 2024, which came out in last month, I think, yeah, in July, beginning of July. So, but you don't need to bother yourself. That the new regulation will not affect your exam. I'm just going to tell you some of those changes in the regulation for the purpose of knowledge, but it's not going to affect this November exam because a new law is usually testable 6 months after the law is being introduced. So it's not going to affect your exam. So rest assured. After that, what are the features of this withholding tax, which we have? So features of this withholding tax. So one of them is that payment of withholding tax is statutory on person making the payment. So it is not something that you say, I'm going to pay, I want to pay, or I'm not going to pay. It is what? It is statutory. It is what? It is your right. The person that want to pay you has an obligation to the government to deduct that money. Failure for that person to deduct, the person will be the one that will bear the burden whenever the government come. Then withholding credit is usually used to offset tax liability. As I said earlier, it will be used to offset your tax liability whenever you are ready to make tax payment. It is an advance payment of income tax, which are utilized as tax credit against income tax of the year of the income and subsequent years to Then some of the withholding tax, they also call them what is called frank investment income, FII, frank investment income. We are going to talk about that one in some later. So we just know that some withholding tax are regarded as well frank investment income. So after knowing the features, the basic thing, one of the basic things you need to know as far as withholding tax is concerned is the types. So as far as withholding tax is concerned, we have two basic types of withholding tax. Two types of withholding tax. We have one, withholding tax payable and withholding tax recoupable or claimable. Those are the two types of withholding tax, payable, claimable, and recoupable. If those of us that are working with audit firm, or if you are familiar with your financial statement, you'll see that in some financial statement, you'll see whether in some assets, you'll see where they will put there withholding tax payable, withholding tax claimable. This is where those activities come from. So what do we mean by this withholding tax payable? So withholding tax payable is the withholding tax deducted from payment made to a third party by an agent, from payment made to a third party by an agent. So you now, if you are an agent for withholding tax, if you are making payments to another person, it is expected, if that transaction is a transaction that attracts withholding tax, it is expected that you deduct the appropriate withholding tax from that payment before paying to that person. For instance, maybe you engage the service of somebody to help you repair your. Sorry, I'm back. All this network can be funny at times. So it was due to network problems, but I'll be able to resolve that now. So as I was saying, before the network went off, so I said we have a withholding tax payable. For this category of taxes now, so any payment you are making. Hello? Hello?
We are with you, sir.
Okay, oh yeah, thank you. So as I was saying, any payment you are making that you want to make to a third party, to another, it is expected that you deduct what is called that withholding tax withholding tax. So that amount you deduct as an agent is called withholding tax payable. So where I was making an example that maybe you as a company, you engage the service of somebody to help you repair, do some work in your office. So, and maybe the contract sum to carry out that work is 1,000 naira. As a company, it is expected where that transaction attracts withholding tax. It's expected that you are not supposed to give him the entire 1,000. That means the contractor. So that 1,000 is the income of the contractor, but part of that income you are supposed to withhold and remit to the relevant tax authority. So that amount you withhold on behalf of the tax authority from payment you are making is what is called withholding tax payable. And this withholding remit it to relevant tax authority. And as we all know, at the end of each year, taxpayer, they prepare their financial account. They prepare account at the end of the accounting period. If at the end of the accounting period, that taxpayer is yet to remit that particular withholding tax to the relevant tax authority, the implication, that means that withholding tax is still the taxpayer is still owing the government that money. So it must be stated in in the company account as as a current liability in their statement of financial position. Note that where it is yet to be remitted at the end of the accounting period, so the company that withhold that money is going to state it in their account because it's not their money. It's the money that belongs to the government, but they are just holding it on behalf of the government. So that is what the withholding tax payable. So that is just the information that is there. After the withholding tax payable, the second one we have is what? Withholding tax recoupable or claimable. Withholding tax recoupable or claimable. It can be any of the two. So this one is the withholding tax suffered from payment you are receiving from where? From a third party. You as a company now, you are also receiving payment from another person. It is not expected that you must be paying. You are also obliged to receive, because you also render some services to another people. So if you are receiving payment from somebody now, that person you are receiving payment from is also expected to withhold an amount from any payment is paying you. So that amount withhold by another person for paying you is what is to you is now called withholding tax recoupable or claimable. That means it's possible for a company, for a taxpayer to have both what payable and claimable. If you are an agent of the government, you can have both claimable and payable. For instance, this claimable is in the sense that, let's say we have equity professionals. As we have equity, you know, equity professional is in the process of rendering accountancy services. So maybe a company now engage them to come and provide lectures to their staffs. So, you know, payment is going to move from that company, let's say ABC Limited, to equity professional. So it is expected that before ABC will pay equity, ABC must also withhold certain amount from the payment they are going to make to equity. That amount withhold by ABC in their hand is called withholding tax, but to equity is now withholding tax claimable or equipable, which they are going to use to reduce their tax liability. Then also, it is possible that at the end of the year also, they are also yet to utilize that withholding tax recoupable or claimable. They must also They must also state it in their account, in their statement of financial position, as a current asset. That yes, so this particular withholding tax is what we want to claim from the government. So we should note that this, when we said a company can have the two, that means it is not possible. As a company, you cannot offset the withholding tax payable from what? From your withholding tax claimable as a taxpayer. What that means is that as a taxpayer, it is not expected that, okay, maybe you are supposed to pay 100 naira. But because somebody has already withheld your money also, which is, let's say, 200 naira, you now decide that you don't want to pay the government the 100 naira, you want to remove it from this. No, it is not allowed for withholding tax. Withholding tax payable cannot be offset from the withholding tax claimable. Though the two of them are what? They are separate items. So they must be what? If you have payable, pay what is due. If you have claimable, claim it from your what? From your tax liability. So that's the reason why what? At the end of the year, one will be stated as a current asset, while one will be stated as a current liability. Any question? Any question?
Yes, I have a question, please.
Okay, I'm with you.
Okay, so I know that withholding is to be when you deduct from someone's withhold, that's the withholding tax payable now.
Yes.
When you deduct from a taxpayer, how am I supposed to put it now?
From
when
maybe a vendor. From a vendor.
Yes,
Yeah.
thank you. When you deduct, I know that you're supposed to remit before the 21 days of the next month.
Okay.
Yes,
Yeah.
so that kind now, when you remit on a monthly basis, is it still necessary to have it in your account as payable or anything like that? Since you already remitted, is it necessary to account for it again?
No. You can see what I said. I said, we're at the end of the year, they are yet to remit. It is only when you are yet to remit it. Anyone that yes. It's when you are yet to remit that you have to state it as either current asset. If you are also yet to claim it, you state it as current liability. But if you have remitted it, you don't need to put it as to state it in your account again.
Okay, so what of the one that you are expecting someone to pay, and then you don't know if the person has paid? I know there is tax promise present where you can either know or
yes.
Okay, so when you go to tax promise and see, you don't account for it again, right?
Yeah, you don't account for it because it will automatically pump up once the person has paid. It will automatically reflect in your on your tax promise portal.
Okay. Okay. Thank you very much, sir.
You're welcome. Any other question before I proceed further?
What if the person refuses to pay or there's kind of a delay? What then happens?
So it is now your own obligation to be on that person's neck, because government cannot do that work for you. Where you have entered into a transaction with somebody, the person has withheld. It is your own obligation as the taxpayer, that somebody that has withheld money from you, to make that person to be on his neck that he should pay your money. Where he refused to, if after the due date, he refused to pay, that the money will also be liable to penalty and interest, which will go to the government. But your own obligation as a taxpayer is also to be on his neck, to be on his neck, to be disturbing him so that he can make payment of that amount deducted on your. So, and if he also fail to pay, you can also make a formal report as well, or to the appropriate tax authority, so that they will know what to do. Any other question? Any question? Okay. Any question? Okay. So let us proceed further. On the other side of the material, page 2, we have refund of withholding tax. Refund of withholding tax. So it is possible that you may also be entitled to refund of withholding tax. For instance, maybe you are a company that is exempted from payment of tax, or you are not liable to tax. But that position must first of all be established between the taxpayer and the tax authority. It must be established that yes, this taxpayer is entitled to refund. So if you don't have, because you have already suffered the withholding tax and you don't have anywhere to claim the withholding tax because you are not liable to tax, or you don't have tax payment to pay. So as a result of that, the tax law has even made it, according to section 63 of SITA, the tax law has made this mandatory, that where it has been established, that is, it is established between the taxpayer and the tax authority that yes, this person is having a withholding tax credit, and that there is no place this person can claim it, or this taxpayer can claim it. It is expected that the tax authority must refund that particular taxpayer within 90 days of application. It must be refunded within 90 days. The tax law has even made it a serious offense. The new Finance Act has made it mandatory on what? On the tax authority to what? To refund any withholding tax that is credit, that is due, that cannot be claimed to what? To taxpayer. So that means what? You are also expected to what? To collect your money back from the tax. That is where you are not what? You are not going to be liable to tax. So, but somebody has already deducted your tax payment. So those are then after that, after the refund, so we also need to, if I say, okay, you are a taxpayer now, I want to pay tax, or I have deducted withholding tax, I want to pay. Do I just go to anywhere to say, yes, this tax authority is closer to me, let me pay here, or this one now is closer to my office, let's go and pay it in the one that is closer to our office? No. There are what? Administration to the withholding tax deducted regulation. So for withholding tax that you deduct from payments that relate to what? Companies. Withholding tax from payment due to companies. Any withholding tax for payment due to companies, that is payable to Federal Inland Revenue Service. That's the only tax authority that collects that for company, because the company will end up paying what is called a company income tax, in which they are now going to use that withholding tax to offset their company income tax. Then another category of taxpayer, we also say we have individual. For individual taxpayer, enterprise, partners in partnership business, unincorporated company. We also have trustee in a trust and settlement. So the withholding tax belong to those category of taxpayer are expected to be remitted to their state internal revenue of residents. Look at it. state internal revenue for individual, partners in a partnership business, enterprise, unincorporated company, trustee in a trust and settlement. They are expected to be remitted towards state internal revenue service of their residents. So that is for the second category. Then for other category, those that are residents at FCT Abuja, Federal Capital Territory Abuja, those one, members of the armed forces, police officer, and members of Nigerian Police Service, those are also payable to the Federal Inland Revenue Service. But under the Federal Inland Revenue Service, we have what is called FCT IRS, Federal Capital Territory Internal Revenue. The Federal Inland Revenue Service, they also have an internal revenue that was established for the people. That one cater for the resident of FCT. So that means the resident of FCT will be liable to their own will be payable towards FCT IRS. That FCT IRS is an umbrella under the Federal Inland Revenue Service. So it's also under the Federal Inland, but it's just relating to only resident of FCT only. Then we have withholding tax deducted from payments due to non-resident. As a non-resident, you can either be individual or company. So for non-residents, that is also payable to a Federal Inland Revenue Service. So you can see in all, FRS is the one collecting bulk of the withholding taxes due to the various category of taxpayers. So depending on but for individual category, any withholding tax, if the individual is not resident in FCT Abuja, it is payable to the internal revenue of their state of residence. Do you have a question? Hello? Do you have a question? Okay. No problem. So thank you. After looking at the administration of the withholding tax, the next thing we are looking at is what? What are those, we are saying withholding tax, what are those incomes or transactions that when you enter into those transactions, they are going to be subject to withholding tax according to the tax law, whether PITA or SITA or any other regulation. So those income, please, this rate will not be provided to you in the exam hall. You are expected to know the applicable rate. You are expected to know the rate applicable to each of the taxpayer. It will not be provided. Some rate will be provided. You know, when we treated capital allowance, I told you the rate for the initial and annual allowance will be given to you in the exam. The examiner is magnanimous to give you that. But for the withholding tax, you are expected to know this rate as applicable. Please, the rates that you will be adopting, some of them have changed. As I said, when we started, there's a new withholding tax regulation. But for your exam, this is what you are still going to adopt. I will just mention those that have changed to you so that for your own knowledge. But this is what you still adopt for exam purpose for now. So then in the case of dividend, rent, and interest, if you are receiving dividend, that means you are investing in a company or you have a property that you are collecting rent from, or you deposit money somewhere that you are collecting interest. Whether you are an individual or company, the withholding tax rate is 10%. That is why you see that most times, if you have a savings account, if you don't make use of that savings account all the time, maybe for some time, maybe 3 times in a month, at the end of the month, you see that bank, they will pay you interest on that savings account, a credit alert. Immediately they are paying you that interest. The next thing you will see another debit alert for withholding tax. So it is their obligation to deduct. Then another one we have is what? Construction and building contracts. Please, for this category of this one, construction and building contracts. Construction and building contracts. So, sorry, before I go to that, dividend, interest, and that construction and building contract. Okay, don't worry. Construction and building contract. This one relates to when you are engaging in construction of road, construction of bridges, construction of building and power plants. Look at it. Construction of road, bridge, building and power plant. Construction of road, building, power plant, and bridges. So when the transaction relate to any of these category of construction process, it is expected that what? Withholding tax should be what? Deducted from that what? From that activity. So please, it is expected that withholding tax of 2.5% if it is an individual that you are making the payment to them. Also for company, 2.5, the same 2.5%. So for both what? Individual and company. Now the rate has been remodified now. The new rate, the new applicable rate now is now 2%. As I told you, the new withholding tax regulation now has now changed this rate, this 2.5% to what? To 2% now. It's now 2% for residents and 5% for non-resident. But I'm just telling you this for what? For knowledge sake. You are still going to adopt a 2.5% for what? For examination purpose. Then we have a contract of supply, agency agreement, whether you are, when it's involved a contract of supply, that you enter into a contract to supply to what? To another, to a company or to another person. So that's before that person, after completion of the contract, before making payment to you, it is expected that what? That person should deduct what is called 5% if the recipient is an individual, and also 5% where the recipient is what? Is a company. So 5% for where the recipient is an individual, also 5% where the recipient is what? Is a company. That rate has also been what? Changed also. It has now become what? 2% now. It's now what? 2%. So by the new withholding tax regulation, which has changed the rate. Then we also have commission and technical service. Commission and technical service. Commission and technical service. So that one, you have what? If where the person receiving that commission is an individual, 5%. Where is a company, it will be what? 10%. Then we also have professional and what? Consultancy services. Professional and consultancy services. So where the recipient is an individual, is also 5%. Where the recipient is a company, is what? Is still 10%. Those one are not changed. They are still applicable as it is. Then we have management services. Then management services. For management services, the same thing as commission, consultancy, and so it is also still what? 5 and what? 10%. Then we have hire of equipment, plant and machinery, and motor vehicle. Hire of equipment, plant and machinery, and motor vehicle. Please, this hire of equipment that we are talking about, they are not hire of plant motor. Let me use motor vehicle as an example. Hire of motor vehicle, it is not, does not mean, it is not when you what? When you engage the service of a Uber. A Uber now. Please, that is not what the regulation is talking about. When you engage the service of a Uber, that is not hire of what? Hire of motor vehicle. What they mean by the hire of motor vehicle is what? For those companies that engage in what? Providing that services. They are into providing fleets of cars to what? To customers. So those are the categories. So don't say because in the previous class you did, you saw that they said hire of motor vehicle. When you now order Uber, you want to claim withholding tax from your Uber man. It is not applicable to him. Please, let us take note of that. Then we also have what? The next one, we have royalties. Royalty is also what? Another form of what? For individual is 5%, and for company is what? 10%. Then the royalty now has also been increased now. Is now what? So it's now in individual. Yes, it's now, it's still applicable. Yeah, it's 5 and 10. Royalty did not change. Then the last one we have is what? Director's fee. Director's fee. So when you invest as a director of a company, if you are a director of a company, now you receive what is called director fee. So it is expected that director of a company must be what? Individual. The director of a company cannot be another company. Even though if it is company, there must be people that what? That float that company. So the director fee is what? Only for applicable to individual only. Please let us take note of that. It's applicable to individual only for the director's fee. So which is what? In that case, so we have it as what? So the director's fee, we have it as what is called 10%. So it must be what? Individual as a director of a company. So that rate has also been what? Increased by what? By the withholding tax, the new withholding tax regulation. It has now been increased to 15% for residents and 20% for what? For non-resident individual. So those are the category of transactions that attract what? Withholding tax. Please let us take note of that. Then, as we have transactions that attract withholding tax, we also have those that are exempted from withholding tax payments. What are those? We need to get those transactions that are exempted from withholding tax payments. So transaction exempted from withholding tax payment. That's the next one. Transaction exempted from withholding tax payment. One of them is across the counter transaction. So like now, you want to buy something as a company or as a taxpayer. Instead of you to ask somebody to give you a quotation to supply you that particular item, you decided to go to the market yourself to go and purchase that item by paying for that item on cash and carry, either through cash or by transfer. So that is what? Across the counter transaction. Such transaction will not attract any form of what? Withholding tax, because you are the one that no contract between you and what? And the seller. You went there to go and buy it. So it is the one that will attract is when there is what? A contractual agreement. That's what somebody gave you a quotation, there's a contract for that person to supply. Then another one is a good manufactured or material produced by a person making the supply. So you are the one producing your goods or manufacturing your goods. So you produce it. So when you want to supply it, you are not supposed to deduct any withholding tax. Then imported goods, where the transaction does not create a taxable presence in Nigeria for foreign supplier. For instance, we have what is called taxable presence and non-taxable presence. So when the goods is being imported, and that person who imported that goods does not have a tax obligation in Nigeria. So because it does not have a tax obligation in Nigeria to pay to Nigeria, so that person, any activity he carried out will be exempted from withholding tax. Then we also have an interbank interest. You have two accounts within a bank or transfer within a bank for the same your account. Any interest that is payable on that will not be subject to withholding tax. Then income or profit exempted from tax. Any income that is exempted from tax is also not subject to withholding tax. Out-of-pocket expenses that is normally expected to be incurred directly by the supplier and distributable from contract fee. Expenses that they are going to, like they are paying for their wages and salary of their employee. So it's what expenses that they have to incur. This is not going to be subject to withholding tax. Claim in insurance business and insurance premium. Any claim you receive, because the claim you are receiving is as a result of you paying premium to that insurance company. So any claim you receive will not be subject to withholding tax. Supply of any petroleum product is exempted from withholding tax. Any petroleum product, LPG, CNG, PMS, AGO, any petroleum product is now exempted from withholding tax. Then any distribution or dividend payments to a real estate investment trust or real estate investment company is provided under compulsory registered security lend. Yeah. So that is what we call real estate investment trust or real estate investment company. So those are the companies that are engaged basically in real estate. Any distribution they make in form of dividend provided that that money, there is a condition, provided that that money is also what? Reinvested. Certain percentage is reinvested back into the company. It will not be what? It will not be liable to withholding tax. Then commission retained by broker from money collected on behalf of principal in line with what? Industry norm. Like now, you are a broker. You are acting for a stockbroking firm. So you now help them to sell a particular shares. So any commission you retain as a result of what? Selling that shares. Commission retained by what? By a broker as a result of selling that will not be what? Will not be liable to withholding tax. Then winning from a game of chance or reality show with content designed exclusively to promote entrepreneurship, academic, technology, or scientific innovation. Look at it. Content designed to promote what? When you have a game that is designed to promote entrepreneurship, academic, technological, or scientific innovation, is also not subject to withholding tax. Some companies, they have what? Like banks, they have regulators. Like other companies, finance company, or all these stock exchange companies, they also have what? Regulator, which is what? Security and Exchange Commission. They also make payments to those regulations every year in, year out. It is also expected that when they are making that payment to those regulations, that payment is also not subject to what? Withholding tax. So that is what? Regulation fee paid to government agency, because it's also a government agency. So those are the words. Please, let us take note of those transactions that are exempted from withholding tax. So any question?
Yes, sir, I have a question.
Okay.
Yes, sir. Under the refund of withholding, you said that where the tax assessed, the tax withheld, rather, where the tax withheld is more than the assessed, the board has obligation to grant a refund. So my question now is that if the tax withheld is more than the assessed, which is the CIT, right?
Mm-hmm.
So if that person doesn't use the old withholding deducted to offset the CIT for that year, can't it be carried forward?
Yeah, it can be carried forward. This one is, when I was mentioning it, I specifically mentioned something that where the person does not have a tax obligation, somebody that is exempted from payment of tax, like a small company now, that that their tax rate is 0%.
Yes.
No place for them to claim it. Even though in subsequent year, there is no place for them to claim it. So in that situation, they are going to get a refund. Those are the kind of scenario.
Okay, so another one.
Okay.
He said the payments made to members of the Nigerian Armed Forces, police officers, and members of the Nigerian Foreign Services. Do those people can you withhold from their money? Do they withhold from someone's money? I don't get that part.
Those people, it's not the money they collect is not only from, they are not collecting money only from the federal government. They also do other activity, other extracurriculum activity. According to the tax law, when they do those extracurriculum activity that is different from their normal activity, you get it now. Like I say, for her, let me use this a good example. For instance, now, maybe you are an army, a member of the armed forces. Because you are a member of the armed forces, that the law does not stop you from owning a house. You can build a house and rent that house to tenants.
Oh, okay.
When that house is being rented to tenants, it is the obligation of the tenants before paying you to deduct.
Okay.
Is it clear to you now?
Yes.
That is where that one coming. You are welcome. Any other question? So in the absence of no, so let us proceed further. We are on page 3. So we have what is called principle behind double taxation relief and withholding tax rates. Principle behind double taxation relief and withholding tax rates. We have what is called double taxation relief because it is not expected that as a taxpayer, I must be restricted only to my country of residence. If I'm financially buoyant, I can decide as a taxpayer to go and invest outside my what? My territorial, my country, to go and invest in other country, if you have the financial means, the law does not stop you. When you now invest in other country, you know that that income is coming from another country. It will have been subject to tax in another country. Also, the same thing. That means if you will now bring it back to Nigeria, Nigeria will also tax what? That income. That is usually what we call a double taxation agreement between Nigeria and some what? And some country. On what? Yeah, agreement. So that's what? Any income that has suffered tax abroad, when they bring it in, there is going to be a relief that will what? That will be granted to what? To the taxpayer. So government is doing that in order to encourage people to what? To disclose their what? Their foreign income. Because if you don't do it that way, majority of the people will just be receiving foreign income and they will be bringing it in through what? Inappropriate channel. They will not disclose to the government. In that case, government will be losing what? Foreign exchange. So in order to encourage people to what? To disclose their foreign income, so that is the reason why what? So under this double taxation agreement, so where we now have a non-resident now, a non-resident that now come to what? To come and what? Establish business in Nigeria, or to come and do activity to come and invest in Nigeria. So for instance, who can tell us when we say a company is a non-resident, what will make a company to be a non-resident? Can somebody assist us? I've mentioned this in one of our previous classes. What will make a company to be regarded as a non-resident?
Can we say when the person doesn't have TIN number?
No. I'm specifically talking about company first now. For company, when the company is not what? Incorporated in Nigeria, that is not registered in Nigeria, does not have what? The CAC in Nigeria, or does not have what? A presence in Nigeria, so it will be regarded as a non. So when they don't have that, if you incorporate with CAC, they will give you have a CAC number. So all those companies that does not have CAC number, they regard them as well non-resident. But the fact that they are non-resident, that does not stop them from carrying out activity in Nigeria or generating income from Nigeria. So that is for company. Also, individual can also be a non-resident where they did not stay in Nigeria for a period of 183 days. So where you don't stay in Nigeria for a period of where you stay in Nigeria for 180, it does not stay in Nigeria for a period of 183 days and more. You are also what? A non-resident, but that does not exclude you from payment. So where I'm going now is that non-resident, either individual or company, now decide to invest in what? In a Nigeria company, or decide to invest in what? In a Nigeria bank by giving loan. So that means for investing in a Nigeria company, that person will be entitled to dividend. And that dividend now will be subject to what? Withholding tax.
Yes.
So, and we know that the withholding tax rate on dividend is what percentage? As stated earlier, is what? 10%. Thank you. 10%. So because government, they want more foreigners, more investors. They want to encourage investment in Nigeria. They want to what? Create more investment. They want to increase investment opportunity in Nigeria. That withholding tax rate of 10% is now going to be reduced to 7.5%. Where this income is what? Is dividend, interest, and royalty. Where the income is dividend only on these three categories of income: dividend, interest, and royalty. Instead of that person to be charged 10%, they were now going to charge him 7.5%. That is if it's a company, if that's non-resident happen to be a non-resident company. So it will be 7.5 on his on his interest, dividend, and royalty. Because when this person gets this particular income also, by the time he gets to his own country too, his country will also charge tax on this income. So, and if the tax is too much. That may discourage what a foreigner from invest in Nigeria. So that's the reason why that withholding tax is reduced for what? For non-resident. If it is an individual now, the withholding tax will also be reduced to what? 7.5 for what? Dividend and interest, and what? 5% for what? Royalty. Because royalty is already what? 5%. So it will still be what? The 5% that is available. And this will be available for all taxpayers that are non-residents with companies that have what? Double taxation agreements with Nigeria. So let us take note of that. You may be asked that it has been tested several times. So they may ask you to write short note on it. So you just give them those information. Let us take note of that. So the next thing now is, okay, I enter into transaction with somebody now. How do I know if I have a right to deduct or not? That is a deduction of withholding tax. Or if I'm going to enter into transaction with anybody, am I given the right by the government to deduct? So it is not every taxpayer that is allowed to deduct withholding tax. Only certain taxpayers are allowed to deduct withholding tax. So the deduction of withholding tax lies with what? Any taxpayer who operates the payee scheme. That means for you to operate this payee scheme, you must be keeping record. It is not only, so that means what that is saying is that it's not only a company that can withhold what? Withholding tax. Individual too can withhold, but it must be what? An individual that is what? Into business. Because for you to be running a pay scheme, that means you have staff that are working for you, which are helping you in doing your business. So any taxpayer that is operating the pay scheme is what? Expected to register and liable to for deduction of what? Of withholding tax. Note that if you are operating the pay scheme. So this set of taxpayer now can be any category. It can be individual, it can be private company, it can be government ministry, it can be government department, government agency, it can be any. Once that individual is operating a pay scheme, the individual, because it is of the opinion that once you operate pay scheme, you have record where you will be doing business to keep your record. So where the tax authority by what can trace your record. But you and I, me and you, that we are in paid employment. We are not what? We don't have the right and obligation to deduct withholding tax. Why? Because if you deduct, where will the government see you to collect from you? So you and I now, we are not agents for withholding tax. So don't go and meet your landlord and say, they said we must deduct withholding tax from your rent. So you are not you are not an agent. It is only when you are operating the payee scheme that you are entitled to deduct the withholding tax. So any question? And failure to deduct, you are also going to be liable to a penalty and interest. So it will be liable to penalty and interest. Any question? Any question? Okay, let me proceed. So also on page 3, so we have remittance of withholding tax. After you have deducted now as an agent, it is expected that you don't just sit down and say, well, maybe I will pay it whenever I like. Government, they also need that money to carry out their day-to-day activity, to provide the basic amenity that they are providing for the members of the public. So they need to. So after you have deducted, it is also expected of you to remit. You are not to deduct and just sit down and say, I will remit it when I like. No, there's a time limit for remitting that amount. So where the deduction is related to deduction you deduct from individual, where it is from individual, partners, those categories that we have under individual, like this, all this category. Let me go back up. This one, this category here, this under when we talk about the administration, this category of people here. where I told you that their state internal revenue where they are resident. This category of people, where the deduction relates to them, it is expected that any withholding tax deducted for them should be remitted within 30 days. For those cards, within 30 days, should be remitted within 30 days when the duty to deduct arose or the date the amount was deducted, whichever is earlier. That is within 30 days. That is, you have entered into transaction. Duty to deduct will arose. You have entered into transaction. It has been stated that we are going to pay you on so date. Duty to deduct start counting on that date, irrespective of whether it is paid on that date or not. Or where you have stated that, okay, we are going to pay you on the 25th, but before 25th, the company has already made the payment. That means the duty to deduct has come before what? Before the date that was agreed. So whichever is earlier, for individual 30 days. While for company, in the case of company, it is expected that it should be deducted within 21 days. Within 21 days from the date the tax was deducted or the date the duty to deduct arose, whichever is earlier. So for company, it's 21. For individual, is 30 days. Please, in the exam hall, where the examiner asks you remittance for withholding tax, note on it. Give him the 2. Where the exam is, you are even lucky that now, you are not doing what? The objective or short answer. So give him the 2 in order for you to have your full mark. So they are not of the same. Failure to remit as at this date, you are going to be liable to what? Penalty and interest. Failure to remit as at that date will be subject to what is called penalty and interest. So which is the next? We are moving. Any question?
Hello, sir.
Yeah? Hello.
Yes, sir. Please, I want to take you back a little.
Okay.
Yeah, we are talking about who to deduct withholding tax.
Withholding tax, yes, okay.
And you say the person must register and the person must have a registered payee. So I want to ask, must the company register before they can?
No, not register. What I mean is that you must be what? You must be a company that is operating a pay system that have record. If once you are a company, you have a right. The reason why they put that pay system is if you are an individual now, if you are not doing business, you also enter into a transaction that will attract withholding tax. But that does not give you a right to deduct. So for deducting the withholding tax, you are not registering with any tax. Once you have fulfilled that obligation, once you have fall into that category of people, either as a company, because once you are a company, there is no way you'll be a company that you don't have staff. Is it possible? Do we have company? Even though if it is one, you have you have one staff. That's what you are going to be removing what their payee. So once you are a company, you have an obligation. So you don't need no registration is needed. That obligation become your obligation immediately. Do you get it? So yes, it is when you now registration in the sense is what if you have registered, okay, if you are individual now, you are just an individual. If you are not operating pay scheme, you are not preparing any account. As your money is coming to your account, you know how you are spending your thing, no account for it. So in that one, you are not obliged to deduct withholding tax. I hope that answers your question.
Yes, sir. Yes, sir.
Yeah.
Thank you.
Yeah. Any other question? So since you are expected to remit as at this date, failure to remit now, you are now going to be liable to penalty and interest. I'm going to demonstrate how the penalty and interest will be. So if you now deducted from company now, the recipient is a company, you are supposed to remit it within 21 days. After the 21 days, you did not remit, that money is now liable to to what is called penalty and what? Interest. So the relevant tax authority, by the time they want to collect that money, or by the time they come for tax audits, they are going to charge you what is called penalty of 10%. They will charge you penalty of 10%. They will charge you a penalty. Can we see the Excel sheet?
No, sir.
Okay, I'm coming. Let me share it. They will charge you penalty of 10%. Can we see it now?
No, sir.
Yeah? No, okay. Coming. Wait. No, it's like the network. No, wait now. I think it's network. So, but as at the time they want to, so they now come for tax audit. They did not ask you if you like when you are paying it, you can pay 6 months after. You can pay any number of months after. But by the time they come for their tax audit, for their routine tax audit that tax authority usually call from, they are now going to charge you penalty of 10%. And also charge you what? Interest at the prevailing what? Monetary policy rate. The prevailing monetary policy rate is usually what? The rate that is usually specified by what? By the Central Bank of Nigeria, the Apex Bank. They are the one that usually will come up with what? MPR. They call it MPR, monetary. So if you are conversant with the fiscal policy, so you will have air of MPR. So that means if you refuse to pay after the due date, you are going to pay the tax due. You are also going to pay penalty of 10% plus what? Interest at what? Prevailing monetary policy rate. So that is what. So that is the situation of what? For failure to pay. Then also, we also have currency of what? Deduction. Please, as far as withholding tax is concerned, the currency of transaction should also be the currency of what? Remittance. Where the transaction is done in foreign currency, you must also remit that withholding tax in foreign currency. So this is how it is now being done. Where the you are not expected to do bureau exchange for what? For the tax authority, because you are not what? The bureau exchange. You are not to change it for them. They are the ones. So how you now do that is that money, if it is in foreign currency, you are going to pay that money through what? Through CBN. You pay the foreign currency to CBN account. It is CBN that will now credit the tax authority the appropriate or Naira equivalent. So that is why that is how it is being done. So you credit, there is an account usually for that, which belongs to CBN if the transaction is in foreign currency, it will be paid to it. Then that foreign currency will now be converted by CBN to what? To the local currency, because we don't spend foreign currency in Nigeria. So the government, they want to encourage their local currency. So that is why. Then under this withholding tax, we have what is called franked investment income. Franked investment, they call it FII. Franked investment income. Franked investment income. I hope you can see my screen, Abby. Yeah? Hello.
Yes, sir.
Yes,
Okay,
sir.
thank you. Yes. Frank investment this frank investment income that we are talking about, these are income that any tax you suffer on them are regarded as what? Final tax. You know, we said withholding tax. When you pay withholding tax, it's an advance payment of tax. But in the case of withholding tax, in case of frank investment income, any tax that you pay on them is final. You cannot use it to offset your tax liability. It is final. It is final. Pata is not available for you to offset your tax liability. And the only for now, before we have 3 categories, but it has now we have 2 now. The only 2 categories of frank investment income are dividend and interest. But depending on the taxpayer, we give you what will be the situation. Please, for company, For company, the only frank investment income for company is dividend. Please let us take note of that. For company, the only frank investment income for company is dividend. So the implication of that is that if you are giving a computation of tax liability for company, if dividend is part of their income, it is expected of you that that dividend must be excluded from that income before you are going to subject the income to tax. The implication of that is that means that dividend is not going to be what? It's not going to be part of the income that will be subject to tax. So it's because it's a frank investment in income. And dividend, how do you know? What will the examiner give you in the case of dividend? The examiner may give you that information in three forms. The examiner may say dividend. Can we see the Excel now? Yeah? Can we see the Excel now?
Yes, sir. Yes, sir.
Yes, sir.
So the examiner may say dividend gross. Look at the way I'm writing it there. He may also say dividend. He may put net in front. The examiner may just give you like this, dividend, and be silent. They may give you in these three forms. Please, whether there's any form the examiner give you dividend, for dividend, it is what? Frank investment income. Please, whether I give you as gross, as net, or as silent. Where it is silent, you assume it is gross. The implication of gross is that means the withholding tax component is also included in that income. That's what they mean by gross. That means, for instance, dividend is 10%. Abi? Dividend, the rate of dividend is 10%. That means if they give you gross, they are giving you the total of what? 100%. But where they give you net means that that dividend, the dividend portion is not part of the amount given to you. That means the amount given to you is 100. Amount given to you is 100 minus 10, because the rate is 90%. So that means the amount of dividend given to when they say net is what? 90%. Then when it is silent, you assume gross. Please, for dividend, it is always frank investment. Anytime you see dividend, eliminate it from your what? From the what? The tax computation of what? Of a company. Because it is what? Frank, any withholding tax they pay on it is final. The only time dividend can be set off is when it involves what? It involves redistribution, which you are still going to meet in your subsequent scenario. So then that dividend now, you can also, then the second category of taxpayer is what? Individual. For individual, please. For individual, the frank investment income available for individual are both dividend and interest for individual. Please, for individual, frank investment income are in dividend and interest for individual. Then the situation will now warrant whether you are going to treat it as a frank investment income or not. Please, in the case of dividend, for individual also, dividend is always frank investment income in whatever form you are giving, whether you are giving as gross, as net, or when the examiner is silent. That means it is always for frank investment income in whatever, whether for company or individual. But in the case of individual, that we said interest is a frank investment income. Please, for individual, interest will become frank investment income only when it is stated net. Interest for individual will be frank investment income when it is stated net in the question given to you. The implication of net is that means the person did not collect his full money. That means that person was suffered tax before. That interest has suffered tax. So it's what? It's going to be regarded as a frank investment income. In that instance, because they believe that interest, most especially individual, they don't disclose interest most time. So that is the reason why it is also part of frank investment income. So basically, Frank investment income are income that once they have suffered tax, it will not be what? Available for any further tax. It's final. So example, dividend and interest. For company, dividend. For individual, dividend and interest. But in the case of interest for individual, only when it is what? Stated net. I hope it's clear to us.
Hello, sir.
So, yeah?
Sorry, I didn't get you. When you said when the examiner is silent on it, it means what?
It means gross. You
Okay,
assume
gross.
Gross, yes.
Okay, sir.
You assume gross.
Okay.
So we also have what is called value-added tax. We need to look at what are the differences between withholding tax and value-added tax. VAT, we all know VAT, which is at the rate of what? Who can tell us what's the rate of VAT?
7.5%.
Yeah, which is at the rate of 7.5%.
7.5%.
Yeah? 7.5%. So that's 7.5% VAT. We also have, and withholding tax is what? At various rates, depending on what? On the nature of the income or transaction. So what are the differences? VAT is an indirect tax because it's a consumption tax. Withholding tax is a direct tax. VAT is imposed on goods and services. But in the case of withholding tax, you know, it's not on goods, it's imposed on what? Income. Income as source, any income that you are generating. VAT is at a flat rate of 7.5%. But in the case of withholding tax, the rate applicable is what? Dependent on what? On the transaction, depending on the transaction. So VAT is backed by the VAT Act of 2004. The withholding tax is backed by the withholding tax new regulation or the CITA or PITA 2004. VAT, it is only FRS that collects VAT. But in the case of withholding tax, it is collected by both what? The one belonging to state will be collected by them. The one belonging to FRS will collect their money. Then VAT, because it's collected by, it is shared by the 3 tiers of government. VAT is shared by the 3 tiers of government. 15% goes to federal government, 50% goes to state government, and 35% goes to the local government. It is for VAT. But in the case of withholding tax, no sharing because everybody is collecting what belongs to them. So do we get that? So those are the differences between what? Withholding tax and value-added tax. The differences between withholding tax and value-added tax. So then we have what? Every taxpayer is able to file. Yes.
Sir.
Yeah?
Hello, sir.
Hello, sir.
Okay, I'm with you.
Hello, sir.
Hello, I'm with you.
That under VAT, you said it is shared by the 3 tiers of government. How?
Government,
Like,
yes.
how many percent for each tier?
Yeah, after the federal government have collected, after parents have collected it, what is collected throughout a month, 15% goes to the federal government, 50% to the state government, and 35% to local government. That's how it is being shared.
Hello, sir.
Hello?
Yeah, I have a question. So
Okay.
you said that VAT is tax on consumption. So where I'm confused is that I've seen someone issue an invoice for a professional fee, and then they usually state that the cost of the audit, the professional fee, add VAT, less withholding.
Yes, now is what?
Sure.
Is what? Is on goods and services. That professional fee is services. You are rendering service.
Goods
That's
and
why it is
services.
also, yes, goods and services. When you are consuming goods and services. So you get it. So that's professional service now. The person is rendering, you are consuming the service of that person. Is rendering service to you. That's why it will be vatable.
Okay, sir. Thank you, sir.
You're welcome. Any other question? Any other question? So let us proceed further. So then you as an agent now, you have withhold tax. You have withholding tax. Do I just go to anywhere, any tax authority and say, take, this is your money? There must be something that you are going to what? Record that amount that what you withhold when you are taking it to what? To the tax authority. So the agent, hello, somebody should mute to. Please, that person should mute his Mike, thank you. So that agent of withholding tax that withhold your money is expected that that person should what? Should give account of all what he withhold to the tax authority. In giving the account of that information to the tax authority, you cannot just go and use word of mouth. You must put it in what? In a particular something. So that means the taxpayer, the agent, the taxpayer who withhold that amount is expected to prepare what is called withholding tax schedule. So what we have here is what is called withholding tax schedule. So that withholding tax schedule is what? Is a document that is prepared by the agent for withholding tax to the relevant tax authority, showing the details of what? Of all the transaction of withholding tax they withhold in their capacity and what? And the relevant tax authority. So that schedule now, the one that belongs to federal government, you do a schedule to what? To FRS. The one that belongs to each state internal revenue, you do a schedule to what? To each state internal revenue. So that schedule, you may also be asked for what? The content of the withholding tax schedule. It's possible. The examiner may ask you for content of withholding tax schedule. So what are the content? You don't need to crack your brain. It's very easier. You know that thing is going to come from the person who withhold your money to the tax authority. That means it must have the name of the company. It must have the name of the company who withhold. That is the agent. The name and the address of the taxpayer acting as the agent. Then the relevant tax authority want to send that thing to. It must also, the name of that tax authority and the address must also be there. It must be there. The name and address of the person that suffered that withholding tax. The third party, the beneficiary, it must also be there because that money is his money, but you are just collecting the tax for government. Then the nature of the transaction. What is the transaction? Because not all transactions are of the same rate. The rate of the transaction that you apply to know whether you apply the appropriate rate or not. The gross amount. How much is the gross amount? The amount of withholding tax deducted. The check number, because by the time you are doing that schedule, you must also accomplish it with what? Payment. That, okay, these are all the payment for that particular month, on or before the 21st of the following month for company and 30 days for individual. Then if it is individual, if it is company, you must also put what? The TIN number, tax identification number of that one, of that particular taxpayer company. If it is individual, for individual taxpayer, they don't use TIN number. What they use is called payer ID. Please let us take note of that. Individual taxpayer use what is called payer ID. But for company, they use what? TIN number. If it is individual, the payer ID of what? Of that individual must also be stated. The date of the payment must be part of what you are going to put. All this must be what? Given to what? To the relevant tax and submitted to them. This particular schedule now, the tax authority has made it easier because of one of the characteristics that there should be what? Flexibility and what? There should be convenience. You don't need to get to the tax office. Just go to any bank. You can even do it online. Just upload the schedule online. Once you upload the schedule, the payments will pop up. You can also pay online or go to any bank to make what? To make your payment. So as at the time you are now making payment, the tax authority must also be responsible. Responsible in the sense that they must also show that they have collected money from you. Because if you pay and they don't give you anything, how will the person that want to use it to claim refund, how is he going to use it? So that means after you have paid and submitted that schedule, the tax authority will now give you what is called withholding tax credit note. So which is the next one. They will now give you withholding tax credit note. This one is usually issued by the tax authority. Now, it's very easier because of the technology. Once you have made pay, you have any withholding tax credit, you see it on your tax promise for a company with FRS. If it is for state, so you just apply. So you also you have your withholding tax credit note, if there is any. Then this withholding tax credit note, the tax authority is giving you. So And when they are going to give you, please note, it's not going to be in the name of the agent. It's going to be in the name of the beneficiary who suffered the tax. In the name of the beneficiary who suffered the tax. It will be the name, that's the withholding tax credit note. You may also be asked for the content of the withholding tax credit note, please. It's also very important, so you may be asked. So we have what the credit note number. It must have a number. The name of the taxpayer must be there, who remitted and withhold. The name of the beneficiary, who you are deducting from, nature of transaction, the date, the name of the bank through which remittance was effected. Then it is important to emphasize that the presentation of letter from collection agent showing that suffer deduction is not, yeah, okay. This one is relating to, this information is relating to government ministry now. When we were talking about those that can withhold, I also made mention of government ministry, agency, department, and so on and so forth. Where they have withhold your withholding tax. When they give you letter, that letter does not show that, so it's not enough evidence that's what, that you are going to get what? Credit, that withholding tax credit note. You must make sure that what? That what government agent, what? Remit that money before what? Before the withholding tax can be what? Can be available for what? For set off. So that is what they are saying. It is important to emphasize that the presentation of a letter from collection agent showing that a taxpayer has suffered deduction is not enough for FRA to grant withholding tax credits. With that, maybe somebody now gave you a letter that maybe we have deducted. FRS will know what? They are not going to reckon with what? With that letter. It is only when upon payment that was it will be reckoned. The tax authority will now reckon with what? With such one. With such that. So there are also offenses and penalties that are also available if you fail as a. So if you fail as to remit, which will be, you are going to be liable to penalty and interest. The director of your company may also be what? Held liable for the payment of what? Of those withholding tax. So you may also be asked, we have the advantages of withholding tax and what? And the disadvantages of what? Of withholding taxes. So any question? Any question? Any question? Oh yeah, let us respond.
Hello, sir.
No, sir.
Hello, yeah.
On the can you come again, sir? The
On which
advantage of
one?
the
Okay, the advantage.
advantages of withholding tax.
I've not taken those one. I've not taken those one. I'm just asking question on the one we have done first.
Yes, I have a question.
Okay, I'm with you.
Okay, so as the person suffering the deduction,
Okay.
let's say I issue my the person suffering the deduction,
Yeah,
now
yes.
has a list of the withholding tax claimable.
Okay.
And then I'm talking about a company now. And then at the end of the year, you prepare your accounts, you file it, and then you have it at the back of your mind that this is what you should have as your credits.
Okay.
Then you now get your tax promise and then find out that what you have as your credit is lower than what you have made, what you have reported in your own account.
Okay.
Yes, that's your schedule. So in that case, what do you think can be done?
In that case, you have to first of all reconcile your schedule with what is on the tax promise to know which of the withholding tax is missing. Which of the withholding tax that was deducted is missing from there. After getting that, the next thing for you is to now be on the neck of what? That's what? That agent. To provide you with what? Evidence of what? Of payments.
Okay.
Those are the things that you can do as a taxpayer. Because you need to, so if you now, okay, somebody has deducted, you are compiling it. You now find out at the end of the year, you are supposed to have 500 million. You are now having 300 million. First of all, reconcile with what is on the tax promise. The withholding tax position that is recorded on the tax promise to know which one is missing from your own list. After knowing that, so you now what? You now be on the neck of what? Of the people that what?
That you
That
were
we told,
supposed to
yes,
remit.
yeah, that we told you amount. When you now be on their neck, if they did not remit after the so those categories, you are still going to state it in your account as what? Current what? Assets.
Okay. Okay, so sir, in such a case that you have checked the list, Abi, those people that were supposed to remit for you actually remitted. Is it possible that FRS will not upload it, or Abi, to not be showing as a credit? Is it possible?
The only it's possible if they mistakenly omitted your TIN number when they were making payments, or there was a mistake, an error when they were making the payment. It's possible. It's basically possible. So where they,
Okay.
that's why, I told you that once you have established that, you first of all ask them for what? Evidence of payments.
Mm-hmm.
So once you are satisfied that they made payments, the next thing for you is to do your reconciliation with FIRS.
Okay.
Yeah,
Okay.
with
Thank you,
evidence
sir.
of payment. Yeah. Any other question? So we have advantages of withholding tax. So one of them, they say it enhances voluntary compliance. Voluntarily, you are willing to what? It's not something that they will say you must do. They will not even ask you. So it's something that somebody will do on your behalf. It enhances more awareness on taxation, because some people, they don't know about tax. But when they now deal in that transaction, they now say, we are going to withhold your amount, your money. You will now look at it that, which one is withholding tax again? Where will they go now? Which one is with? So with that, you'll be able to know more about what? About tax. It reduces incidence of tax evasion, because government, they know that people, taxpayer, they don't even want to pay tax. So if they don't collect that money as source, for instance, somebody that invests in a company, that the company is going to pay a dividend now. By the time the company now want to pay the dividend, if the company did not deduct the withholding tax, do you think after the person has received that dividend, he will not go and report to tax authority? Do we think that will happen?
No, sir.
It's not possible. Nobody will do that. So as a result of that, is why governments, they decided to bring this form of tax. It helped to bring what? Unknown taxpayer into tax net. Yes, people that they are hiding. Once they do in any transaction now, those people that they did transaction with, we record them. So with that, the tax authority will be able to know them. It makes tax payment less cumbersome to the taxpayer, who may not bother going to the tax office to pay his tax again. If his withholding tax is much, he may not even bother that he's going to pay again, because he's going to have a lot of tax credit. It helps to bring obscured transaction into the tax net. So those transactions that most time you are not going to be aware of. Like in the case of that interest that I talk about, for somebody in paid employment. If the bank does not deduct it withholding tax as source, that person that is paid employment will not go and tell his employer that, I also have another source of income. Add it as part of my income and charge it to tax. Lie is not possible. So then it helps to strengthen the tax machinery by engaging numerous official of collection agents in tax work, even though they are not government workers. Yes. So more people are involved, because everybody is an agent for collection. So you are acting for the government. So then as a result, tax collection will become what? Easier. So those are the advantages. So let us also look at the disadvantages a little bit before we go. A high rate of withholding tax is likely to affect the operational performance of most business. That's the reason why that's rates in the new withholding tax regulation. The rate now is even being reduced for what? For some company, for contract now, that they now reduce it to 2% instead of the 5%, because they find out that money, if it's still with the company within that 1 year, they can still use it to carry out some activity that will make profit to them than government collecting it ahead. The application of withholding tax affect the cash flow of most business, yes, as they receive money less than what they have estimated or budgeted for per invoice they have issued. Yes, it's going to reduce your income. It's likely to encourage hard work by revenue officer. Likely to discourage hard work, since it is self-accounting in nature, because somebody is already doing it for them. they may say that, okay, don't worry. Maybe even though if they know that somebody that has deducted, if the person did not pay, you come and report that person to the tax official. So as a result of that, you have done their work to make their work to be easier. Then it leads to what? Locking up of capital of some business with the revenue agency. Yes, your money will be with your agency, the money that you are supposed to use for. So before we go, let us look at this practice question 1 first. It's just written. We are going to state the information by ourselves. The solution are not there. We are going to state it by ourselves. So look at it. The question 1, they said the administration of withholding tax is the responsibility of appropriate relevant tax authority. State the relevant tax authority responsible for administration of the following. Oh yeah, so I want to hear our voices. Number 1, company. Who is the relevant tax authority in charge of companies?
FIRS.
Do we all agree with that?
Yes.
Yeah, firms. What about firms?
And what's the firm into? What's it about?
So that is so when they say firms, what does it mean? You have to look at it.
Mm-hmm.
Oh yeah, firms, yeah?
You say the state internal revenue.
Are you sure?
Yeah, that's why I wanted to just know what the firms are, because most firms that I know, they are usually partnership or business entities like that. Most of them are not companies. That's why I said that.
When they say
I
firm,
want to know.
firm are group of industries that are group of a company that are in the same industry together. Group of companies in the same industry.
Okay.
That's what they mean by firm here. Not
Okay.
accounting firm. If they say accounting firm, they will put it there. Group of industries. Group of what?
So
Company
that's
that are in the same
accounting
industry. Like what? Tobacco industry now.
Hello.
All the companies there, they call them a firm.
Okay, so that's FIRS.
Do you all agree?
Yes.
Resident of Federal Capital Territory, Abuja.
FCT
FRS.
Yeah, it's not
FIRS.
FRS, so it's not FIRS, so it's FCT. I made mention of it. FCT IRS. It's
Yes.
FC. Don't go and write FIRS. So then professionals.
State internal revenue.
Why?
Because they are mostly partnership.
Yes, thank you. Those are the ones that you are referring to earlier. Like your accounting firm, we are partnership business, enterprise, and so on. So they are state internal revenue service of what? Residents. Then individuals.
State internal revenue.
Member of the foreign affairs. Members of the foreign affairs.
FCT IRS.
When they say somebody is a member of the foreign affairs, yeah?
Sorry,
Hello?
sir. I was locked out by the network. Please.
Okay.
So
Okay. Where did you
get the
stop?
answers from.
For which one? From where?
From companies.
Okay. Companies. Oh yeah, somebody should help us. They are what? Companies is what? FIRS. Then firm. Wait, firm. I said firm is what? Group of what? Company that are operating in the same industry. They call them firms. Those are the firm. Yeah. So group of companies that are operating in the same industry, like tobacco industry, bottling industry. So they call them, the group is called firm. So that one too is also what? FIRS. Resident or FCT, Federal Capital Territory. That is to where?
FCT
Yeah, FCT Internal Revenue Service. Then professionals.
Sorry, before we move on, this resident of FCT, I want to understand, because there are companies in FCT. Those companies now that are operating
individual. Residents.
Okay, so this resident is
individual. Yes.
Okay.
Professionals.
State internal revenue.
Yes, of resident of what? Of the individual. Then we have individual as well.
State internal revenue.
Then we have member of foreign affairs.
Yeah, you were explaining that one.
Somebody was answered the question earlier and said FCT IRS, Abi?
Yes.
Why? Why do you say FCT IRS?
Because they fall under the category of this
Okay, what are we
When
asking?
we're
When they say member of foreign affairs, who are those people?
they are government workers.
Are you government worker like what? Which category of government worker?
I'm
Please,
not sure.
it is what? Federal FIRS. These are what? The Nigeria ambassador outside Nigeria. Those are ambassadors that represent Nigeria outside. They call them a member of foreign affairs. Those ambassador to UK, ambassador to data, citizens of Nigeria, but that are representing Nigeria in other country. They call them members of what? Foreign affairs. Please let us take note of that. It is to what? Federal
FIRS.
Inland FIRS. So please let us take note of that. Any question? Any question? So in the absence of no question, so we are going to stop the class at this junction. So we are going to continue with the computation next class before we go to another topic. Maybe we are moving next after the computation. We'll be moving to VAT in our next class. So we can as well read ahead. So for that. So any question?
No, sir.
Okay, thank you very much and have a lovely day ahead.